In this brief video tutorial, I'll be going over how to complete end of chapter problem 6.2 found in your course textbook on pages 184 and 185. You'll see I've already taken the time to transfer all of the information provided in the case example into a new Microsoft Excel worksheet. Letter A asks us to explain how each amount in the flexible budget was calculated. The hint that Gopinski gives you here is very important, so let's take a moment to read it. It says, examine the simple budget to determine the relationship of each budget line to volume. The reason why we need to evaluate the simple budget in order to look at the relationship of how the flexible budget was calculated is because if you recall, flexible budgets, whether you're talking about revenues or expenses, are based on volume changes. So again, when we're looking at volume changes in a flexible budget, it's very helpful to understand what the multipliers may be from a simple budget, which again Gopinski gives you here. So in cells A12 through A14, I've done this intermediary calculation to help you understand the relationship between patient revenues, salary expenses, and non-salary expenses per surgery or per changes in volume. So this number of surgeries equals the volume. So you can see here, when we have a volume of 1,200 surgeries, we generate patient revenues of $2.4 million. The reason why this is read $2.4 million and not $2,400 is because the case example told us that the numbers are reported in thousands. So essentially you're multiplying all of these numbers by 1,000. So this again is not read 2,400, but it's 2.4 million because there are 3 zeros here that were taken out because the statement said that we are reading this in thousands. So again, if you look at 1,200 surgeries generates $2.4 million, the same logic can apply to both the salary and non-salary expenses. When we have 1,200 surgeries, our salary expenses are $1.2 million and our non-salary expenses are $600,000. So you can quickly see the relationship here based on volume, and that's why I have these 3 items carved out down here, that when we have a volume number, you essentially double that in order to get patient revenue, or you can interpret this to mean that per surgery we generate $2,000 worth of patient revenue. And how you calculate that, double clicking in this cell, you take the patient revenue divided by the number of surgeries, which gives you patient revenue per surgery. So again, you're taking the 2.4 million divided by the 1,200 surgical surgeries, and you get a value of 2 or $2,000 of patient revenue per surgery. That same logic applies to both salary and non-salary expenses, meaning that it takes $1,000 of salary expense per surgery and it takes $500 worth of non-salary expense per surgery. The reason why I don't have number of surgeries down here and profit down here, well, number of surgeries, that would be volume, so that's what we're basing everything on. We don't need to do any intermediate calculations. And the profit value is really just a simple equation of revenues less salary expenses less non-salary expenses, so we don't really need to pair that against a surgical volume. So here's your relationship and answer to letter A. So keep in mind, everything that we just calculated here is really understanding how the flexible budget is created by understanding the relationships. But these are still budgeted figures. These are not actual performance numbers. This is just how we plan or make a financial plan around the performance of the organization for Brandon Surgery Center. Letter B asks us to determine the variances for each item of the P&L statement, which would be all of these items here, in both dollar terms, which is going to be done in column F, and in percentage variances in column G. So again, the simple equation here, actual, we're going to use the flexible budget is 0 because we had projected 1,300 worth of surgeries, and our actual performance, we came in at 1,300 surgeries, so the variances, there is none. We can copy that down. And in terms of a percentage variance, it's the actual divided by the flexible minus 1. Again, use autofill to complete that. So I've gone ahead and formatted these cells so that these would be dollar values and these would be percentage values. This one's not a dollar value because it's a count of surgeries. It's a volume figure. And again, there was no variance because we met our target of number of surgeries spot on, and so there was a 0 surgical variance, and also that results in a 0% variance. For these other numbers, you can see here that our actual patient revenues were less than the flexible budgeted. So our actual came in at 2.5 approximately $1 million when we budgeted $2.6 million, and that's a variance or a difference of $65,000. This results in a 2.5% negative variance, meaning that we came under our projected patient revenue amount by 2.5%. So this would be an unfavorable variance because we're dealing with patient revenues. Anytime you perform under or less than what you had budgeted, that would be unfavorable. In terms of salary expenses, we expensed almost $1.4 million when we really projected, or as our flexible budget outlined, we were only supposed to be projecting a $1.3 million salary expense. This resulted in a $65,000 overage, which resulted in a 5% unfavorable change, or an unfavorable performance indicator. For our non-salary expense, you can see we actually expensed $585,000 when we had projected to spend $650,000. So this is a favorable $65,000 variance because it's an expense line and we came under what we had budgeted, and this was 10% less than budget. So this is a 10% favorable performance indicator when we're talking about non-salary expense. And again, the last line here for profit, we came in at $585,000. We projected to have a profit of $650,000, and therefore our variance is $65,000 under what we had anticipated, again resulting in a profit for Brandon Surgery Center 10% less than what we had originally budgeted. And again, because this is a profit line, being under the budgeted amount by any percent would be interpreted as an unfavorable performance indicator. Well, I hope you found this video helpful. Thank you for watching.